Okay, hi everybody. Welcome to our webinar on aspects of the Brexit debate, the departure of the UK from the European Union. We're trying to cover a lot of detail here, but hopefully there'll be some useful context in particular to help you get stronger marks on evaluation. So the UK is set to leave the European Union single market. The single market is the third form of integration between countries. The first is a free trade area. The second is a customs union, and the third, deeper level of integration is a single market. And the European Union single market is built, of course, on four key freedoms, namely free trade in goods, free trade in services, that's 1 and 4, free movement of labour, people can live, study and work in any other EU country, and crucially, free movement of capital. Financial capital can flow between member states, insurance services, banking services, free movement of capital in terms of foreign investment, etc. So the single market is an important, significant form of integration in which the UK is set, as we speak, to leave in 2019. Since 1957, there have been 6 main waves of enlargement of the EU. The European Union has widened as opposed to deepened. The UK joined in 1973. So 46 years later, we're set to leave. And then there's been, as you can see from this slide, a succession of countries joining the European Union, including in 2004, of course, 10 countries becoming new member states. Bulgaria, Romania, 2 relatively poor countries, joined in 2007. And of course, latterly, in July of 2013, Croatia joined the EU. So UK is the first member nation to leave the EU. Article 50 was pressed in March of 2017. And this, of course, was about 9 months on from the referendum, June the 23rd, when Britain voted by 51.9% to 48.1% to leave the EU. Scotland, Northern Ireland and London voted to stay, to remain. Other regions of the UK, as you can see, voted to leave. The context, I suppose, is the UK's trade relationships with the European Union. This is the 2015 data for the total value of our trade in goods and services by country. The USA is the biggest single export market for the UK in terms of value, Germany a close second, but as you can see, European countries, Germany, Netherlands, France, Ireland, Belgium, Spain and Italy, they account for a significant percentage of total trade, in fact about 45% of our total exports. China comes in at 6th. Switzerland, of course, is outside the EU. So 7 of the top export markets are with European Union countries, and of course that emphasises the importance of the trade agreement or the arrangements that we make when we leave. Likewise with imports, Germany is the biggest single source of imports coming into the UK, and China is second. Again, Holland, significant percentage. Obviously the Rotterdam effect kicks in there, the port of Rotterdam, through which many goods travel, and that's the import allocation. Britain runs quite a hefty trade deficit with the European Union. So you can see there are some countries we run a trade surplus with, but for example Ireland. But significantly, we run huge trade deficits with countries such as Germany, mainly manufactured products, and also with Spain. Obviously, things like tourism is a big Spanish export. So there are many ways to leave the EU. At the moment, the debate seems to be between a hard and a soft Brexit. These words are largely media creations, but essentially, a hard Brexit means that we leave the single market and then we trade under WTO, World Trade Organization rules post-2019. Under those rules, it's important to understand, for revision, that each member nation must grant the same market access, including the same import tariffs to all other members as the most favoured nation. So if we left under those rules, and if there was no free trade agreement, we'd have to pay European Union tariffs, which are currently on average around 5%, although they're much higher for certain products. A soft Brexit, which at the moment, at the time of this webinar, seems unlikely, but a soft Brexit would involve staying, for example, in the single market, like the Norwegian option, which we'll look at in a second. Norway is part of the European Economic Area. It has a free trade agreement with the EU. and that means there are no tariffs, no import tariffs. There are many ways to leave the European Union. So from an evaluation point of view, Brexit doesn't necessarily mean Brexit. There's different shades of Brexit in that sense when a country departs. One of the options is a so-called Norwegian option. So the Norwegian option would be that the UK would stay inside the single market. They would accept free movement of goods, services, capital and people. The latter, of course, is probably going to be highly problematic for any new government. Norway is inside the single market but has no formal shaping of the rules. It can't influence the rules and they have to pay an annual fee for access to the single market. But crucially, under the Norway option, all the sort of financial services from the UK will be mutually recognised. So the UK financial services companies would have passporting rights. Norway does not include free trade in food, or it's not part of CAP. It's not part of the common fisheries policy either. Another option is to join the European Free Trade Agreement, Free Trade Area, so EFTA. That will provide the UK with less access to the single market beyond trading goods, tangible goods. This is the so-called Swiss option. So Switzerland is a prominent member of EFTA, but it's required to strike bilateral treaties with the EU to secure access to the single market. And again, Switzerland makes a small per capita contribution to the EU budget. Again, that's unlikely to be the case. So it's more likely we'll probably leave the EU under WTO rules, be outside the single market, would face the European Union's external tariffs, certainly initially, but that would give us more control over migration policy. We no longer have to accept free movement of labour, and of course it would allow us to, in theory, over time, make trade agreements with many countries around the world, including Australia, New Zealand, Canada, United States, and countries like China and India. Economists for Brexit, a group of sort of free trade economists to the right of the spectrum, they would make a case for the UK completely leaving the single market, pressing for free trade and basically having border controls on labour and full democratic control of the UK laws. A crucial question, I think, in the debate is what happens to our financial service sector. It's not the only important industry in the UK, of course, but it's a significant one in terms of exports and GDP. There are some fears, of course, that London might lose out from an exodus of skilled labour and trade if we don't have access to the single market. So financial services is a key sector potentially affected by Brexit. But I think the evidence is that a mass exodus from the UK is probably unlikely. London retains many strengths, a large pool of very skilled workers, human capital is very good, economies of scale, very experienced financial service sector, English language of course, and our time zone is convenient. It's also likely the UK government will probably seek to protect these sectors where there's a lot of inward investment, so financial services, the car industry, etc. But we can't ignore the possibility of what's called Brexodus. This is where people leave, banks for example leave London and decide to relocate elsewhere. Most commercial investment banks want to keep a foothold in the EU single market. That's well understood. So Deutsche Bank, for example, is probably going to relocate several thousand jobs somewhere else in the EU. And typically the cities that are mentioned in terms of Brexodus would be cities like Frankfurt and Paris and perhaps also Dublin. So there's a likelihood that many thousands of jobs will disappear from London as financial service businesses set up relocation in other countries. So there are many options. This is just a kind of summary. We talked about the Norway, the Switzerland option, the World Trade Organization option. Turkey stays within the EU Customs Union. That would be an option perhaps, but it's likely that the UK will probably try to negotiate its own bespoke entry arrangements not covered by this slide. But on the left hand side I've got there 7 key factors you might want to think about in terms of the trade-offs and the choices that the UK might have to make in any future trade and investment relationship with the other 27 countries inside the EU. Another evaluation point is to think about which countries might be most directly affected by Brexit. Here's 4 countries I think of particular relevance to you in your A-level studies. So Netherlands has 7% of trade, 7% of UK trade. as a share of their GDP, but actually quite a significant percentage of investment. The Netherlands and the UK are actually quite closely aligned in many European Union policy debates. The Netherlands wants reform of the EU, and they may well push for those reforms once the UK leaves. Clearly, Ireland is the most deeply integrated country with the European Union in terms of trade, also significant investments, and of course it's the only country with at the moment a soft land border with Northern Ireland. Germany, about 3% of trade is with the UK, measured as a share of their national income, less as a share of investment. So Germany is clearly a globally scaled economy, exports to all corners of the world. And Spain, about just 2.5% of trade as a share of GDP, but 6% of investment. So a lot of European countries have a vested interest in finding a suitable trade and investment agreement. This is significant for advanced countries. In terms of the fiscal effect, Britain is, and has been for many years, a net contributor to the European Union budget. So in 2016, 2017, in net terms, Britain paid or pays into the EU around £10 billion more than we get back in the form of structural funds and farm subsidies, etc. And that's a relatively low share of our GDP, but it's not an insignificant amount. So in net terms, Britain would be fiscally probably better off in the short term from not having to pay into the EU. But of course, one of the big debates, one of the negotiating discussion points is the legacy payments. Britain is committed to certain European projects for the next 5-10 years, and there may well be a bill to pay in terms of the UK having to commit to its contributions somewhere between, let's say, 20 and 60 billion pounds, although some parts of the media think it's much higher than that. The short-term impact of Brexit, of course, all focused on the effects of the referendum vote and whether the UK economy would tip into recession. We know that following the referendum, the pound fell by about 17-18% immediately. It's now recovered a little bit. It's recovered by about 6 or 7%. But the pound is still lower than it was before the referendum. So that's obviously caused some higher inflation in the short term. But overall, I think there's a lot of text on this slide, but I think overall the UK economy has recovered or responded pretty well to the Brexit vote. The doom and gloom that there will be an immediate recession certainly hasn't happened. The UK economy has continued to grow, house prices have continued to rise, unemployment's continued to fall. There are some signs, though, recently that the growth of GDP is now starting to slow down quite considerably. And in part that's because of the higher inflation, and in part it's because the fall in the exchange rate hasn't yet really kicked in to drive exports higher. Another aspect you might want to think about as part of your revision is not just the impact of Brexit on the UK or the impact of Brexit on advanced countries like Germany and Holland and France and Spain, but also to think about the impact of Brexit on developing countries. Again, much depends on the nature of any deals that the UK makes with the EU, but there will be possible consequences for trade, foreign investment, for growth, for aid, for remittances, and also for global collaboration. So there may well be an effect. Here are 3 possible effects. There are many, but I've just picked up 3. So if the UK economy, for example, grows more slowly over the next 3 to 5 years, let's say, then there might well be a contraction in exports to the UK from developing countries. They may find it slightly harder to export to the UK. Perhaps countries like Bangladesh in textiles and Kenya in farming, for example, might be most effective. Clearly, we don't yet know what the effects of migration controls will be post-Brexit. It's likely, though, that migration flows in the long term will fall, although the short term they may rise. Crucially, the fall in the value of the pound reduces the value of remittances sent from the UK back to emerging developing countries. So countries like Nigeria, Uganda have been affected by that. And crucially, post-Brexit, a big question mark, a big area of uncertainty is what will happen to the UK aid budget, which was just under $20 billion in 2015, 0.7% of GNI. A fall in the pound cuts the real value of aid. A lot of aid flows through the European Union, and the key question is whether the UK will maintain its aid commitments after Brexit. In particular, will it be able to afford to do that, or will it change the definition and the calculation of what counts as aid? But I think the key point view for the essays and the exams is to say, well, look, Brexit won't just affect rich advanced countries. There could well be consequences for particular countries with whom the UK has a close relationship, or the EU has an important relationship. One of the exam boards asked specifically to think about the micro and macro effects of a decision to leave the market. Let's just spend a few minutes practicing that. So here are some of the micro effects of the UK leaving the single market. On the one hand, well, if we're leaving a customs union, that might lead to higher import tariffs on EU exports. So that will cause UK firms who import from the EU to have higher costs, and that could cause a fall in their profits. However, evaluation point, it does depend on whether the UK is able to negotiate a free trade deal with the EU before Brexit is finalised. I think on balance that's unlikely. It may take more years than just 2 years. Some firms and industries rely heavily on inward migration from the European Union, particularly in hospitality and construction and farming, and also in tech sectors. So that may cause firms at the micro level to suffer labour shortages, which could increase wage inflation and make some firms less competitive. On the other hand, Britain will have to pay less into the EU, so there's perhaps potential for an increase in the budget to fund technical training, vocational training, apprenticeships and things for UK workers. Another micro effect is that leaving the single market may well cause some delays at borders, particularly if the UK firms have to comply with sort of non-tariff regulations and things. And many products cross borders several times before they reach the consumer, so that's going to cause an increase in firms' costs. However, a lot of UK exporters already comply with European regulations, so that's not a problem. And actually, Brexit campaigners argue that once we leave the EU, there'll be less red tape for businesses anyway, which will cut their costs. On the macro side, there are lots of points here. If we leave the EU, allows the UK to make free trade agreements with other countries. So we might be able to sign a free trade agreement with India, for example, or China, or countries in sub-Saharan Africa. So that could help our export sectors. Evaluation point, however, these trade agreements take a long time to come to fruition. The recent European Union-Canada free trade agreement took 7 years to agree. Another possible macro effect is that if we leave the single market, that will allow the UK to limit net inward migration for the EU. That's going to, in theory, provide more opportunities for British people to find work. Might also keep house prices and rents a little lower. However, the key question is whether the labour market in the UK has the skills, unemployed people have the skills to meet the demands of employers. Many sectors suffer from skill shortages. How are we going to staff the NHS, for example, which is heavily reliant on migration? A third macro point is that leaving the single market diminishes trade with the EU, and actually that might make the UK less attractive for inward investment. Nearly half of our trade goes to the EU, and if we have higher tariffs, that would make it more expensive for foreign firms to locate in the UK and then export to the EU, which in theory could be damaging from a macro perspective. Again, evaluation point, this depends on the trade deal we make with the EU. Hopefully that will encompass investment. Low tariffs and things will help keep investment high. And anyway, inward investment doesn't just depend on import tariffs. It affects on things like business taxes, corporation taxes, the quality of the labour force, and the sort of stringency of regulations. Okay, so lots of evaluation points you can bring in. There have been lots of surveys, many surveys on what's likely to happen to the UK. I tend to favour academic surveys. One recently published by the LSE, published and surveyed here, and their argument is that the costs of leaving, or the economic effects of leaving, are negative. They have an optimistic scenario and a pessimistic scenario. An optimistic scenario is that the increase in tariff barriers is small as a result of leaving the EU, and that Britain does benefit from a sort of reduced fiscal contribution. But on average, the costs in the optimistic scenario is £850 per year for people in an average household, rising to over £1,600,000 a year in the pessimistic scenario. So on balance, most economists think in the long run the British economy will be worse off outside the single market. But I'm sure if you get this question in the exam, you'll be absolutely bursting to put in lots of really good evaluation points. So here we are. Here are a few "it depends on" points just to finish off with. So, what will be the consequences of Brexit for the UK? Well, here are 6 "it depends on" evaluation points. Classic evaluation tactic, isn't it? First of all, it depends crucially on the scope, the scale, and the timing of any trade deal that we're able to do between now and Brexit, or perhaps as part of a transitional deal lasting, let's say, 5 years. Crucial point there is the relative strength of the bargaining power. When the UK sits down to negotiate with the EU, who actually has the upper hand in bargaining chips? A second evaluation point, it depends on whether the British economy can keep a large number of highly skilled EU workers post-Brexit. Will people stay or will they leave? How many will stay? And that has significant consequences for businesses such as coders and tech companies, engineering businesses, universities and things. It has a big effect on the NHS, no question. Another consequence depends on the impact of Brexit on universities. Universities are a major part of our economy now. Their annual output is about 3% of GDP, nearly 750,000 jobs supported by the universities. To what extent will a fall in EU students coming to the UK have an effect? And crucially, maybe an exodus of academics in STEM subjects, in the social sciences, etc., who leave the UK to move to Canada or other European Union universities. 3 more points. Another effect depends on the ability, and this is quite important, the ability of UK manufacturing businesses to modify their supply chains. If you've got products coming in from Belgium, from Germany, from France, from Holland to make your product in the UK, will UK firms be able to find those component parts from other British businesses, or will they have to make some adjustments to their supply chains? Potentially a big rise in costs for UK businesses there. Some exporters in the UK will say, well, actually, instead of focusing on the European market now, let's focus on pivoting our export sales to non-EU countries, including emerging Asia. On the fiscal side, the impact depends on the extent to which the British government can actually replace existing EU funding. Will research grants continue to be funded by the UK? How much support will farmers get? How much regional support will there be for areas like Cornwall and Wales and the northeast of England? Will the UK government be able to help continue to fund places like workplace training initiatives in the Erasmus programme for students travelling and working overseas? There's no guarantee that the UK government will maintain the same funding, and that could have a big effect on the supply side. And most of all, and this is my final point, the significance of Brexit, I think, depends not just on the static effects, what happens if a tariff raises price, etc., but the dynamic consequences of a change in our trade investment relationships. So, for example, if we're outside the EU, if we're outside the single market, to what extent does that have an effect in dynamic terms on the productivity of our businesses, on the rate of innovation in key sectors? And this is where we do fear that we have an exodus, for example, of skilled academics and coders and highly skilled people who decide that Brexit is not for them. If we have an exodus of human capital, then there could be quite a considerable negative long-run dynamic effect for the British economy. Obviously, we wait to see. There is so much uncertainty at the moment. This is clearly going to be a factor for many years to come. So there we go. I've taken you through the European Union and Brexit. Hopefully I've given you some really good contextual data and contextual examples and some evaluation points to think about. So if you get an exam question on Brexit in 2017, you should be in good shape. We'll do another Brexit talk in 2018 because obviously by then the situation may have become a bit clearer. Good luck in your exams. Check out our YouTube site for more videos and talk to you soon. Take care.